Okay, let's welcome Tim Nelson, Head of Economics, Policy and Sustainability at AGL Energy.
Thank you both Frank and thank you for ANU for having me here today. It's a shame these are going to be up in a couple of weeks because I promised my mum and dad and other family members that I had a cure for their insomnia, which was to log on to this tonight. But what am I going to talk to you about? We've had a couple of papers published recently, just down the bottom of that slide, that really start to, I guess, unpick some of these issues around integration of electricity, and I say electricity very distinctly there from broader energy and climate policy. People use climate and energy and electricity quite interchangeably. The focus of this is really on electricity. So energy-only markets and renewable energy investment. Just to give you a bit of a feel for some of the research that goes back a couple of years. This emerging theme of barriers to exit. We're in an industry that has very high fixed costs for new investment in generation technology, and that's competing with incredibly low short-run marginal costs of incumbent plant. The treatment of financing costs I'll park there as a separate issue. So you've got these carbon sunk costs in electricity markets that all, if you throw them into the mix, create a very complicated situation where the intersection of climate and electricity policy becomes very problematic, and I guess we've lived through that policy experience over the past couple of years. And I guess just to give you a bit of a feel for where I see some of the policies moving forward. So energy-only markets and renewable energy investment. I'm not going to labour on this slide other than to point out that if you look at the history of the national electricity market, depending upon how you define average annual prices, we've only been in a situation where the average annual price exceeded the new entrant cost of a combined cycle gas turbine in 1 year. From the market start back in the late 90s. Now, what's the point of that? Well, the point is that in the early years, the market was heavily oversupplied due to the incumbent state electricity commissions being gradually privatised, disaggregated into their supply functions. There was an overhang of capacity associated with a very significant build-up in the 80s and 90s. But as we went through this period, a new plant was built in response to higher pricing signals. The prices didn't actually ever, on an annualised basis, exceed what you would call the most economic low emissions investment in that particular market. And so if you look at what was driving new investment, most of the investment in this period, and this just shows the megawatts that have come into the market, so in the early years, it was all driven by this separation between peak and underlying demand. There was a need to provide firm capacity for higher pricing events. There's one afternoon, I think it was in 2002, where one particular retailer, I won't name who it was, but you know where I work, lost a lot of money because it didn't have sufficient hedges in the market, and that led to this building out of capacity, so things like open cycle gas turbines. You come into this period of the market though, and all of the generation that's come into the market has been driven by two factors. The first is the underlying economics of the investment operating in an energy-only market, which is what our NEM is. The second are the host of particular external policies, whether it's RECs, now LGCs, the GGAS scheme, the Queensland 13 then 18% gas scheme, the VRET scheme. There are a whole bunch of these policies that brought capacity into the market. Now, those policies are all, depending upon your point of view, entirely valid, reasonable policies. But is it a valid point to say that those who had originally designed the energy-only market never anticipated these policies working together? I think that's a fair point too. So, if you think about this from a theoretical perspective, and you always have to have an economist present a partial equilibrium graph, so for those in the room that are economists, you'll like this. So what we're talking about is you're basically shifting the supply curve. You're basically saying we're going to add supply into the mix, and that's going to be through new low emission technology, whether a CCGT under the Queensland scheme, other types of schemes than renewables. But one of the most important characteristics is what I think the panel were just talking about earlier, which is these particular types of investments are characterised by relatively higher fixed costs, but very, very low short-run marginal costs. We all know the wind and the sun is free. Yes, we've got access to very low-cost coal in Australia, but compared to free, low cost is still more expensive. But the other implicit assumption in energy-only market design at the time was that demand would increase. And so you can see that theoretically you shift supply and demand and you maintain price at a higher quantity. That was the predominant thinking. And if you go back to the expansion of the renewable energy target, it's no coincidence that most of that new capacity coming into the market was going to be absorbed by higher demand. If you go back, I think we were anticipating something in the order of 300 terawatt hours by 2020. And we're nowhere near that. And even with the turnaround in demand that Tony was talking about, you'd be a very brave betting person to say we're going to get anywhere close. So it's this failure for the left hand and the right hand really to be talking to each other and anticipating what might change into the future to make our policy frameworks robust. Now, the other point, though, that I'd make is that we've gone through a whole debate around this merit order effect. But I think one of the most important parts of the story around the investment in our generation stock is that as you move from one particular long-run average cost structure to a higher long-run average cost structure, the total costs to society are going to increase. But, and I use the term but, what this doesn't take into account is the fact that we are going to have to replace the existing generation stock over the next 20 years anyway. So you're not comparing the short-run marginal cost over the life of an asset from today with a brand new asset with the short-run marginal cost of a new renewable. You're comparing the long-run marginal cost of both over that time frame. So those costs are going to be nowhere near as divergent as some people claim, but likewise, they are going to be higher, based upon current technologies. The other issue with energy-only markets is that you're not paid for capacity, but you are paid for your energy. And the intermittency issue, which everyone talks about, you get a lot of people who blame, in inverted commas, renewables for causing all of these issues. Renewables are an entirely sensible way of decarbonising, but you need complementary technology in the market to facilitate when the wind isn't blowing and the sun isn't shining. Now, that might be battery storage, it might be open cycle gas turbines, it might be hydro, whether both run-of-river, dam storage, pumped hydro, whatever it might be. But at the moment, what we know is that there's a whole bunch of older plants in the market that are effectively seeing a decline in their energy, but they're still being used at times when those intermittent sources aren't there. And I guess the question is that over time, and this paper that we wrote a couple of years ago that was published last year said that over time that's going to manifest in one of two things. You're going to see extreme pricing volatility as you move to a market with very, very high penetrations of renewables, or you're going to see reliability issues. Now, that's not to say that it's going to result in a reliability event in the next 6 months. It might take 10 years for it to manifest. But given these are long-lived assets, we need to get the policy right today so that we can see both reliability and cost effectiveness into the future. That's just another take on the capacity utilisation story. You can see capacity utilisation maxed out in this period, and then you've seen this decline over the past several years. I've used the exact graphs out of this published paper. If you extended it out, you'd see the same type of trend. So, with all of that said, in my mind, the energy-only market is unsustainable once you move to very, very high concentrations of intermittent renewables. Now, that's not to say that the only answer is a thermal plant in an alternative market design. It might be advanced battery storage in an alternative market design. But longer term, we're going to have to accept, I think, that as we move to much, much higher fixed cost investments, having a market that clears every 5 minutes to settle every half an hour with extreme pricing volatility when you're really talking about high fixed costs that are amortised over 20 years doesn't make a lot of sense to me. And that's, I guess, the challenge that I've put out there. Now, that said, finding an alternative market design then opens up a whole can of worms around what's going to work in a better way. But at least if we accept that we've got to try and work on that problem, we've overcome at least one of the barriers. So in my mind, there are these 4 potential barriers why we're not seeing more old plant permanently retiring. The first is policy uncertainty, and I guess the selfish, kind of semi-part-time academic in me remarks that someone did mention to me this policy uncertainty has been terrible for the country, but it's been certainly good for your publishing career, having written a few papers on it. That said, I'd quite happily give up all of the papers if we could sort this out. But I think if you're a board operating any of these assets around the country today, you'd be very brave to make a permanent capital investment decision. And I think Steve summed it up really well. Carbon pricing in the short term will have a great impact on operational decisions. Capital investment decisions, I'm not too sure it's going to influence because of that history. The second is that so much of this plant is beyond its original design life. Now, that said, I think Tony made a very valid point as well, which is it's a bit like the grandfather's axe. How much of it is actually the original plant versus plant that's been refurbished, I think is a valid point. That said, there's one other complicating factor, which is when you move into a world of much greater intermittency, you want quick start plant. You don't want clunking old coal-fired generators that weren't designed to ramp up and down quite quickly. First mover disadvantage, and this is the beauty of Frank and Salim's model. It really does deal to this issue of, yes, there will be winners out of any regulatory closure type model. How do you essentially try and create a bit of a game to price out those costs? And then the last one, which is remediation costs. It's a simple time value of money. The further I kick this can down the road of having to remediate a mine, the better off my shareholders are. So to give you a feel for what the supply curve in our market looks like, that's what it looked like in 1998, and that's what it looks like today. Now, if you contrast the front end of that curve, you'll see all of this very, very low-cost plant that's come into the market. And that's a great news story for decarbonisation. There's a graph that is in this particular paper that shows the material success we've had in reducing the emissions intensity of the NEM. It's actually a very, very good news story. That said, we've got to get the market design right as well. So, complementary policy required. In my mind, and in this particular paper we published, we identified 3 models that could be used. And then I think the fourth, and sorry Salim, I'm suffering from the same thing. I always make the comment that when you're the second author, I kind of have that with Paul Simshauser. Everyone always talks about Paul Simshauser's papers, and I'm like, yeah, but I was on there too. So in my mind, the most elegant of the original 3 was that market-based mechanism. But like a lot of elegant things that economists like myself think are really cool, people then point out all of the practical holes in it, and you think, okay, I'll go back to first principles. Regulatory closure, the thing that it has going for it is it's simple. Everyone can get their head around it. It's a very easy thing to get your head around. Government funded, to the point made before, you get into a whole range of why should governments pay shareholders to close their assets. And my personal view is I think that of the 4 we've got up here, I think that has a lot going for it. And I'll leave to Frank to talk about that. But I think that in my mind, and a lot of the work that I'm doing now in the sense of thinking about further research, is this energy-only market design. So we can deal to the barriers to exit issue, which will facilitate, I guess, some more confidence in investing in renewables and getting to the REC build out to 2020 and beyond. But longer term, we're going to have to deal to this. Is the market design right for very high penetrations of renewables? So carbon pricing, sunk costs in electricity markets. I guess the point that I'd make here is that because of the gross pool energy-only clearing market mechanism that we have, to facilitate transition of new coal for new gas, you actually need a fairly low carbon price. By the time you're getting into displacing the old incumbent plant with very low short-run marginal cost, you need a much higher carbon price. And I think that the point that was made in the previous panel is that is the community ready for such a materially higher carbon price than we've had previously? I'll leave that for others to judge, but I think that the beauty of a closure model is that effectively it's pricing it implicitly, not explicitly. So policy recommendations, and I'm going to highlight that one. And I know everyone talks about it all the time, but it's so important that we have committed in Paris as a country to getting to 2 degrees. That's going to require a material transformation of our electricity sector, very significant. At the moment, if you look at, say, whether it's the National Electricity Law or a whole range of other mechanisms, there's no mention of greenhouse gas emissions, climate change, or 2 degrees. If we're to see this integrated, we really need the left and the right hand to be acknowledging what the other one's doing. So, and there's a lot of words on this, and I've really put this here more for people to refer to later on the website. But I guess what I would say is that at the very least, we need emission standards for all new power stations. The profile of a new coal-fired power station is completely inconsistent with us meeting our obligations from Paris. So we know that. We just need a regulation that gives force to that. Now, whether it's regulation or some type of market mechanism, I think that there is an argument for using some type of mechanism to drive out the older plant. And then I think that we do need continued incentives for zero emission energy. Now, I make an important caveat there. The economist in me says that it shouldn't be just renewables. It should be all technologies that get you to zero emissions. Why do I think that's so important? Australia has vast coal reserves, vast gas reserves, vast reserves of other energy stocks. It's in our interest to see technology at least developed in those areas. Now, it may be that those technologies never compete with renewables. It may well be that. But I think it would be wise for Australia to look towards its strategic advantage that it currently has with energy and at least try and see new technologies develop there. And if they don't, then at least you can say you've given it a go. The other aspect of our market, though, that does require rethinking is financing. So if I take away the research hat and just put on my AGL hat in the sense of what a business is thinking through, it's this: how do you match the risk profile of a new renewable investment with investor appetite? So what this shows is that to get to around, and this is very rough numbers, but around 5,000 megawatts of new investment to meet the RET, it shows the different credit rated loads in the market. So you've got residential credit rated commercial, and then non-credit rated. Why is that so important? Well, to get a project over the line, you need a PPA with a credit rated entity for a bank to lend or to provide the debt to get that project financed. So by definition, unless we change the way in which people think about financing, half of the RET will require some new type of financing. So the Powering Australian Renewables vehicle that AGL announced a couple of weeks ago, it's designed to try and facilitate this financing innovation so that we see that keep pace with technology innovation. Now, again, sorry, Frank, I should have cleared this slide with you, but you cannot do yourself any more of a favour than buying that book. It has a chapter by me in it, and it's coming out very shortly. If you want any more information on anything I've spoken about, you can get it from those sources. So there's the shameless self-promotion. And looking forward to some criticism in the Q&A.
Yes, time for a couple of questions. And Tim, we should mention your academic affiliation as well. You are Associate Professor at Griffith?
Adjunct.
Adjunct, of course. They don't pay you, that means.
Yes.
Any questions right here, right now on the presentation? Please. And
jump in if no one else will. Thanks, Tim. Craig Memory again, Energy Consumers Australia. Really interesting presentation there. I'm interested in the idea of what about just fixing some aspects of the market and then letting the market work it out. So, for example, it's obvious that coal-fired power stations, thermal plant, have provided some benefits that they haven't really been compensated for, like inertia and so on, which is creating problems in places like South Australia. I heard someone refer to South Australia as the canary in the coal mine recently, and I thought maybe it'd be a bit more apt to refer to it as the canary in the wind tunnel, given where they're going with issues with maintaining inertia on the market. Additionally, there's a lot of solar is being introduced. There's no reason conceivably that couldn't become semi-scheduled in the same way that wind energy has at scale. So wouldn't it be possible conceivably to introduce a market for inertia, maybe introduce some semi-scheduling, the right sort of cost signals for batteries, and then not be in a position where we've got an unstable energy market that requires such a considerably expensive measure as closing down plant, especially given that you pay twice for incentivising closure of plant. You pay once up front and then again when the wholesale prices go up in response to the decreased level of capacity.
On the second point, I'd say that I think that's the beauty of the next presentation's proposal, because it does tend to deal with that uplift and at least trying to capture it back. On On the question of how you design the market longer term, I think some things like adjusting the FCAS market or introducing some type of market for inertia, it'll buy you some time. But the question I have is that in our market, which is moving towards almost 100% fixed costs, very, very low short-run costs, I think having a trading market that's designed to kind of clear every half an hour, it just, longer term, and I'm talking much longer term, 20 years from now, it just doesn't make sense. There are very few examples I can think of anywhere in the world where you've got markets where all of the infrastructure is heavy fixed costs and yet it's traded almost instantaneously and continuously. So I think it's just a mismatch of design versus the technology that we're likely to see.
I'm picking up on your point about technology neutrality towards the end of your talk. And I suppose my immediate thought was about nuclear, but this question is in fact also about coal as well. And how do you make sure that either nuclear prices or coal prices have the cost of remediation built into them properly?
I'll leave the nuclear question. Just because I have no expertise in nuclear. On the coal question, I think that the critical issue in my mind, and I'm starting to, in terms of what I do for AGL, I'm starting to field a lot of questions for investors asking for increased granularity of disclosure around remediation assumptions. So the assumption that you've got a number on your balance sheet for liabilities, for a liability in the future, I think that historically that's been acceptable to investors, but I think as we move forward, I think you're going to see more and more desire to unpick that and say, well, what are you assuming? What date? And how are you discounting that back? And are you assuming that you've got ongoing provisions where you're remediating as you go? Those types of things. So I think it's a very valid point. I tend to think that over the next 12 to 24 months, you're going to see companies changing the way in which they disclose on that basis, because I think that's what the market's going to want.